What is going on, everyone? Welcome to the ideal banking system. Today, we're going to talk about business and personal allocation. So, just a side note, there's three things I want to discuss here before we go ahead and jump in. Number one, if you're just starting out your business for the first time ever and you have not received an invoice or a check or income yet into this business and you're going to study this training, study it and implement it immediately. Because if you do, you will find yourself operating like $1 billion organization from the very first dollar coming in. And it'll save you a lot of time, energy, and effort. It'll save you a lot of potholes that you might hit in your entrepreneurship journey, and you'll find yourself on the road to success. This will give you so much clarity and confidence to build your business financially that you will be excited to win every single day a check comes in. Every single day, income comes into the bank account of Ideal. And when I do these allocations, it excites me. So that's number one. Number two, if you're operating a business already and your business is doing $250,000 a year, right? Maybe $1 million a year. Maybe your business is doing $10 million a year in gross revenue, like a friend of mine who lives in Puerto Rico. And he called me, and he happened to call me 2 years in a row. And he was operating his business. It's making $10 million a year gross revenue. But for some reason, because he doesn't have his banking system set up properly for him to win, he knows how to make money. But it's a difference from knowing how to make money to know how to allocate your money, to know how to multiply your money. So today we're going to talk about allocation. And when the IRS would call him or send him a letter saying, hey, you owe us $200,000, and he looks in his bank account and he doesn't have $200,000 to pay the IRS for that year, that's a problem. And that's a problem we're also going to solve on this banking system called Today. We're going to make sure that no matter what, you're guaranteed to have tax money to pay the IRS. And not only that, if you got a good tax accountant or a tax professional, which I recommend you guys all go search for on your own time, they will help you lower the deductions in your business so that way you're actually not paying a whole lot compared to what you're earning. And the third thing I want to touch on before we dive into this training is if you're a person on this call and you're watching this training and you're like asking yourself this question, well, I'm not an entrepreneur. I don't have a business that I'm operating, nor do I care about ever starting a business. That's okay because we're going to talk about personal allocation, but it's very important for you to understand business allocation over personal allocation so you can get clarity for your life. Not only that, you guys will probably enjoy having a conversation with the owner of maybe the business you work at, or you will understand your business. If you're looking for a raise, this is a very good example before I jump into this, a very good example. If you're looking for a raise at the job you're at right now, let's say you work at a small business that's doing like $5 million a year in gross revenue, and you're like, man, I see this business is doing $5 million a year, but you're only getting paid $17 an hour, and you want to get paid $25 an hour. Because you're going to understand how a business operates, now you're going to understand why the owner of that business is not willing to give you a $25 an hour raise and maintain you at $17, and maybe you might get bumped up to $18 or $19. So you're going to have more clarity for why in the workforce, why in a corporation can I not earn more? And it might be because the business is operating at a lower expense rate, so they can't afford to pay you. And we're going to dive into that heavy. So I am Michael. I am your co-host, not your co-host, your co-founder of Ideal with the other amazing co-founder, Blake Hahn. You guys all know and love Blake as well. So let's go ahead and dive right into this training. So I would assume, maybe not all of you guys, but most of you guys, if you're watching this, let's talk about the real revenue range first that we're going to talk about today. We're going to talk about if your business is earning $0 to $250,000 a year in gross revenue. Okay. So we're on the same page. That's the revenue range we're going to talk about. Now let's dive back to what I was saying. I would assume, not all of you, but most of you, this is what your bank account looks like today. If you logged into your app on your phone, you have a debit card that's linked to a main checking account where 100% of all your revenue is in there. Now, of course, you're going to have a savings account. It may have $1 like all of my saving accounts do at a bank because I don't save in a bank, right? Money is meant to be out. That's why it's called currency, right? It's meant to be out and it current. You're supposed to get it out and get it out and get it out and get it flowing. I'm going to train you on how to get it out and get the savings out and put it into a checking account that's going to operate moving forward in your business. So let's discuss that. Now, this real revenue in here, the reason why this is wrong and the reason why you're looking at it and you're like, okay, well, yeah, I got $10,000 in my bank account. This looks good. However, most companies operate sales. Let's say $10,000 in sales came in minus expenses. Let's say we have on the left-hand side over here, we got marketing was $1. Say you paid somebody $1,000 a month for Facebook ad, for your business. You owe a contractor $1,000 in payroll for doing services for you. You have about $1,000 in subscriptions for your business, which these 20 little $30, $40 fees add up. It could be your QuickBooks. It could be, a legal subscription. It could be anything that you have, marketing subscriptions, email marketing subscriptions, all those little fees add up. And then impulse purchases. An impulse purchase may be your printer ran out of ink, and so you need to run to the store and grab ink immediately. A lot of these tiny little nitpicky impulse purchases in business tend to happen. I actually have a budget for impulse purchases to allow me to go buy random stuff on the spot. Now, most companies, it's very normal for them to operate this way, but it shouldn't be normal. This should not be normal. Sales minus expenses equals profit. So what we're saying is out of this $10,000, after all the expenses were paid over here, you have $6,000 left in profit for the business. Okay, cool. We did put payroll. Let's replace this payroll with someone in the company, and let's say you paid yourself $1,000. But if you didn't pay yourself $1,000, what are you paying yourself? See, and most people will operate with the mindset of, well, I'm a startup, so I can't pay myself till the company turns profit. And okay, that's a great thought process to have, but wouldn't it be better if you could pay yourself immediately the next check that comes in? Or if you're a new business, the very first invoice that gets paid, you get paid? I'm going to show you guys how to operate like that. This is how billion-dollar corporations operate. And that is the completely wrong way to operate your business. You should not be having $10,000 in sales comes in, figure out what are all the bills I have, make sure all the bills are paid, and then whatever happens to be left, that's your profit. Completely wrong. But let's turn that around and let me show you guys what to do immediately starting tomorrow. So we're going to go open up the following additional checking accounts over the next hour of me explaining this at your bank. Just so you know, yes, you could go to your bank and you can open up an unlimited amount of checking accounts underneath your business entity. So what we're going to do here is we're going to open up a profit account. So for every single dollar that comes in, we're going to change how we operate. This time we're going to say all the sales, $10,000 in sales, minus profit. If you're earning 0 to 250K, you're going to put 5% aside for profit for your company. So $500 is going to get allocated from this $10,000 into this profit account. And now you got $500 in profit. So when somebody asks you or an investor asks you, yeah, how profitable are you guys? We don't know. When you're operating like this, you don't know because it's all in one account. But if an investor asks me now, I can open up my bank account and I said, yeah, we're at $500 profit. Awesome. I know that immediately. Whatever money happens to be left, that's what I have to operate my business now. Okay. And I'm going to dive into more detail as we get through this to make this make more sense and more clear as we go. So what we're also going to do is, I talked a lot about taxes at the beginning, right? As entrepreneurs, we heard pay yourself first, pay yourself first. As an entrepreneur myself, when I heard pay yourself first, with no guidance, with no coach, with no mentor, I would pay myself first and I would immediately go blow that money on something for myself. And that's the wrong way of pay yourself first. Pay yourself first is take the profit for your business first, so that way you can see what you actually got to run the company. So the next account you're going to open up is a tax account. And you're never going to touch these two. You'll never touch your profit account and your tax account. Yes, you will, but I'll tell you, when in another training. I'm not going to go over it in this training. I'll go over maybe in a version 2 training of what you're going to do with your profit account and what you're going to do with your tax account. So I'll make 2 sets of videos, maybe 3 sets of videos for these, because as you get to earn more money, you're going to see how valuable this system really is. So out of that $10,000, you're going to allocate $1,500 here to taxes. Now, when I was talking about my buddy in Puerto Rico who's earning $10 million a year, if he put $1.5 million aside for taxes, what happened? He only owed $200,000. So you would think for somebody that owes $200,000, which is 2% of taxes, right? If he put 15% aside in a tax account, he would have 1.5 million. His tax attorney did a good job, or his CPA or his bookkeeper or whatever, got him down to 2%. So the IRS called his phone and said, hey, you owe 2% of taxes, 200,000, and he still didn't have it. Why? Because if I go back again, we're operating like this. One checking account. We tend to have an idea. Let me tie this to impulse purchase real quick. When we're operating this way and we see that we have $6,000 in profit left, an impulse idea we might have as a business owner is like, okay, I got $6,000 to operate my business. I need a laptop. Let me go buy a $1,200 laptop, and I need a brand new printer. Let me go buy a $500 printer. And so you start to eat into this number, which is really eating into this profit number, and it's eating into this tax number. You see how if we just bought a laptop and a printer right here, if this tax, that's a laptop price, $1,500, and that's a printer, $500. We just ate out of our profit and our taxes for our company. So you can see how somebody makes $10 million don't have money to pay the IRS at the end of the year. So ask yourself, well, the number one question entrepreneurs ask is, well, in a startup, how do I pay myself? And you have to understand, if you're operating the business, you need to survive. So you will take 50% of the owner's comp from this income account. So you're going to open up another account and you're going to label it. You can nickname all your accounts this, by the way. If you log into my business account and my personal account, they're nicknamed like this. So you'll see a real revenue, 100%. You'll see a profit, 5%. Tax, 15%. Owner comp, 50%. You will see my accounts nicknamed exactly like this. It looks identical. Now, 50% of that revenue, if $10,000 came into the door, you would need to pay yourself $5,000 as owner's compensation to survive so you could keep operating that business. Let's go back here. If you did that and you paid yourself $5,000, you would only have $1,000 left to operate your business, or $1,000 left for profit for the company. But if you do it this way, you have $500 in profit, $1,500 in taxes. You paid yourself $5,000. I'm going to keep going so you guys get ahead. Now you operate your business based on 30% of the revenue of what's left, which is your operating expense account. So let's break this down. 100% of the revenue is here. You allocate 5% to profits, 15% to tax, 50% to owner's comp. That leaves you with 30% left to operate the business. That's a great number. I didn't do this on a purpose, but the reason why I like this is because look at this number. $10,000 comes in, you only have $3,000 to operate your business out of this 10,000. Let's say it was 10,000 in a month that came in, right? You only have $3,000 for the next month to operate your business. Let's go back a couple slides. Let's go here. You spent $4,000. You overspent $1,000. So you're operating at, negative $1,000 out of your pocket. Or if we come back to here, you're taking less compensation. You're going to either take $4,000 to make up for that $4,000 that you spent on the other slide, right? So you're either in the human mind, right? Our habitual behavior is going to tell us, okay, well, I got $4,000 to operate. Dang, let me pull $1,000. I'll pull $500 from owner's comp. I'll pull $500 from tax account, and I'll put it in my operating expense. And that is also wrong. That's the wrong way to operate your business. What is in these accounts must be used only for what is in that account. Now, you'll notice you see debit cards over here to the left. You will only request a debit card from your banker at your bank for the real revenue account, which you get anyway, and for the operating expense account. You will not ask for a card for the owner's compensation, the tax, or the profit. I'll continue down that here in a minute. Now, let's say this is the standard. You guys are looking at the standard of a business that makes $0 to $250,000 a year. This is a standard setup. This is what your bank account should look like within 24 to 48 hours of watching this training. You should go straight to the bank and open up these accounts immediately, right? 1, 2, 3, 4, 5. You'll have a total of 5 accounts. Now, if you're like me, and as you grow as a company, you're going to want to diversify and keep track of just more information. The more information you could track, the more you care about your business, right? If you're not tracking it, you don't care. So let me give you guys an example. Right here, the next slide. So if you see this operating expenses was 30%, and on this slide it's 28%, because you only have $3,000 to operate your business. But let's say you went and the bank gave you a $5,000 credit card. So for me, I opened up a credit card account to make sure that I put 2%, which is $200 for every $10,000 that comes into the bank. I put $200 in that credit card account. Why? So I could pay down my credit card every single month or as much as possible, right? However, this is part of operating expenses. My credit card is a part of my operating expenses. So when you add a new checking account to track something else in your business, you only pull it from the operating expense percentage, not owner's comp. You don't say, hey, I'm going to change owner's comp to 48% and add 2 to here. This is why this category is orange. You only pull from here. I'll give you another example. Pay attention to the 28%, drops down to 23%. Why? Because let's say you're a fashion business, or maybe you're not a fashion business, any company you want, either corporate merchandise, right, for all employees, or maybe you're a fashion company, so you're putting money aside to make another bulk order, and your order cost, let's say $2,000. Let's say the next order you're gonna put in for apparel, for merchandise, costs $2,000. Well, for every $10,000 that comes in, you're gonna allocate 5% to that account, which is $500. So now as a business owner, you need 10, 20, 30, 40. You need $40,000 in income before you're allowed to place that order of $2,000 for merchandise. And again, all you're doing is you're taking your operating expenses. You would have paid down your credit card. You would have ordered merchandise from it. But now you're gaining clarity for this. You can add a payroll account. You can add, so if you're paying staff $3,000 a month in payroll, you can open up a payroll account, make sure money's being allocated to that, and so on and so forth. So this could go a lot of different ways. You can open up an account for legal. If, let's say, you're trademarking stuff and you're copywriting information and you're calling attorneys for help for XYZ, you might want to open up a legal account and allocate funds to there so you can make sure you're always paying your legal team. So there's a lot of stuff you could do here. You could put office building. If you have an office building and you know your rent is $3,000 a month, you can make sure you're adding rent money to another account, but it only comes from this operating expense account right here. 30%, you can see when you diversify it again, it breaks down to 2%. When you diversify it again, it breaks down to 5%. Now you'll see I have an A here. Let me hop over here. So let's talk further, because this whole entire conversation I was talking about 0 to 250K. When you look at your business account now, if you opened up your business bank account app and it looks like this, and let's just take a look at this right hand column right now, and somebody says, hey, our laptop broke at the office, I need a new laptop, right? Let's say you're running an operating and a laptop broke, company laptop broke. Well, you could go straight down to the operating expense, see that you have $2,300 in there, and you can say, okay, cool, boom, and go buy a brand new laptop because you know you can afford it, right? So, but some people might make the impulse purchase of like, hey, you know what? The lease for this new place is $5,000 a month. Should we get it? You go straight to the operating expenses. No, we only got $2,300 in there. What this is going to do is your operating expenses tell you what you can and cannot afford. I'm going to go back to the very beginning right now. Or I won't. Let's see. I was going to go back to this slide, right? This slide right here, your marketing expenses. Can you afford marketing? Can you afford payroll? Can you afford your subscriptions? Can you afford your impulse purchases? Well, if we're here and I only got $3,000, let's say I'm averaging about $10,000 a month. So I'm at the 120K a year range, right? $10,000 a month comes in, I'm operating at $3,000 a month. Well, if your subscriptions are $1,000 a month, you only have $2,000 a month to operate. See what I mean? So when you're operating, you can only build your business from here. Now, if you have too much expenses, your business is going to tell you you cannot afford it until you make more money, right? So if you have more money going out than coming in, this is where you get to see it, right? Let's come back down to here. This is where you get to see the full operations of your business and how you're operating. And imagine another $10,000 hits. And then this goes up to 1,000, this goes up to 3,000, this goes up to 10,000, so on, so forth. What I wanted to do, and you're only going to have a card for here. Now, let me talk about what's next. Let's say you're going to pay down the credit card, this $200. All you're going to do in your bank account app is you're going to transfer this $200 back to this account, pay with a card. When you're going to order the merchandise for $2,000, when this hits $40,000, you're going to take $2,000 out of here. You're going to transfer it back to your operating expense account, pay with a debit card, right? So if you're a business and you're operating real revenue, and real revenue is not gross, this is like profit. So real revenue is if $10,000 came in, you might have received $15,000, but you paid contractors and you paid everything that it cost, all the goods, you paid for all the goods it cost for that service that you're operating for, and you're left with $10,000. That's real revenue, right? So the B column is all the percentages of your bank account at 250 to 500K. You'll see your profit went up to 10%, right? You'll see your taxes always stays at 15%. You can see your owner comp drops down to 35%. And you can see your operating expense goes from 30% to 40%, right? So now you have more with the same $10,000 for 250 to 500 grand. Now, let's say you're a business operating at 500,000 to a million. Well, what you're going to do is your profit goes up to 15% and your tax goes up to 15%. Now, your owner's comp drops down to 20%, but you get to operate off of 50% of the revenue in your business moving forward. Say your business is earning $1 million to $5 million. This is column D. This is business allocations for if you're a D business. You will drop. Now you'll notice your profit actually drops from 15% back to 10% when you're making $1 million to $5 million. Your taxes stays permanently at 15%. Your owner's comp drops from 20% down to 10%, but now you have 65% operating expenses to operate your business. So now for every $10,000 that comes in, $6,500 is to operate your business. That's amazing, right? For every $10,000 coming in, you're taking $1,000 home. Amazing. And now you're operating a full-fledged business that's earning $1 million to $5 million, right? I would rather earn 10% off of $5 million than 50% off of $250K, you know? So, because your business is growing. Now let's talk about the next one. If you're a $5 million to a $10 million business, that I call it the E column, your profit goes back up to from 10 to 15%. Your taxes stays at 15 as always, and your owner comp drops from 10 to 5%, but you're still operating at 65%. This is normally standard now moving forward, because if you're a $10 to $50 million business, column F business, you are now taking 20%. You see, you go from 15 back to 20. You see, you go from 10, 15 back to 20% in profit for the business. Again, your taxes stay at 15. Your owner comp drops to 0. When you're at 10 to 15, because a lot of you guys on this call might be well, how do I get paid if my business, if I'm earning 0? If you're earning $10 million a year in gross revenue, your owner comp plan changes. So until you get there, you'll understand that down the road. That's another advanced training. Then you'll be operating off of 65% of the company. Amazing. So here's some key nuggets. Let me see what's next. Okay, here's some key things that I'm not going to dive into in this training. I'm going to dive into it in another training, but I'll give you guys a quick little sneak into what would be discussed, because I know you guys have conversations going on in your head. So this tax account, remember the 1.5 million if it was $10 million a year business, my buddy in Puerto Rico? Well, if you put 1.5 million in this tax account and you only owe 200K, what do you do with the other $1.3 million? Well, with your, that ends up being a bonus for yourself. That could be a bonus to buy more equipment for the company. This is where you see business professionals go and they buy a new car, right? You might see somebody buy a new Lamborghini or a new Ferrari, or they buy a new house, right? Or they buy a new office building. They start to expand. This is where that comes from. Because the better you could get at paying down your taxes and only know 2% rather than 15%, that all becomes bonus money. It could become a bonus money for all your employees. Imagine $1.3 million. You took $300,000 out of that, not even all of it, and you just gave bonuses out to everybody in the company, right? $1,000, $2,000, $5,000 check bonus to everybody in the company until that $300,000 is used up. So there's a lot you could do with your tax account in the future, which we'll get on. Maybe I'll have our tax attorney hop on and explain this more, so you're hearing it from a professional. So let's talk about the number one question entrepreneurs have when starting a business. Give me 1 second. I'm going to take a sip of my coffee before I continue. Okay, so how do I pay myself from my business? This is a startup question, right? This is even an advanced question for someone like my buddy out of Puerto Rico who was paying himself completely wrong, or myself. My first 7 years in business, I was paying myself wrong and my taxes were messed up. Here's how you do it. The $5,000 that you have right here, you could either set up a wire-to-wire software, right? And there's many of them out there that transfer it straight from this account into your personal bank account, right? In this case, I'd be paying Michael, the personal bank account. Here's what I do. I take this $5,000 and I transfer it back to the debit card account or the main checking account, because the main checking account is where you write your checks from. So I'll transfer $5,000 out of the account that says Michael, and I'll put it in here, and I'll write myself a check here for $5,000 that goes into my personal allocation account. Now, I want to say something very specific right here, because some of you might have business partners. Yes, the owner's compensation gets split between business partners. So you guys know the amazing Blake Hahn, my business partner. This account would actually be 25% and 25%. So I actually have an account that says owner's compensation, Michael, and the other account says owner's compensation, Blake. And this, rather than saying $5,000, would get split between us, and it would say $2,500, $2,500. So just for clarity, that's how that is allocated right there. Now let's take this $5,000, we transfer it to here, and we write ourselves a check for $5,000. Here's that account, right? So here's my income. Now, again, we're back to, now here's the start of our personal. This was the end of our business conversation, right? F, from 10 million to 50 million, and there's more advanced stuff moving forward. This is just the basics to get you set up for success. So now we're jumping into the first conversation we're going to have about personal allocation. And I can move a little bit smoother here since you guys understand the business. Now, remember at the beginning, if you're that person listening to this training right now and you're asking yourself, well, I want to raise. Remember I was saying I want to raise from $17 to $25? If we go back to this, ask yourself, where is your company's real revenue range and how much do they have for operating expenses? Because you get paid based out of what the company has left to operate. So let's go back real quick. If you're working for a small business, they only have, for every $10,000 that comes in, they only have $3,000 to invest into an employee at max, right? And most employees earn $3,000 a month. So if the business is making $10,000 a month, they only have enough for one employee, right? And they really don't have enough for an employee. They have enough for a part-time because they're going to need to put money aside for credit cards, money aside for merchandise, money aside for XYZ, inventory. So think about this the next time when you're asking for a raise. Understand from the back end, a business might be operating with low operating expenses and they're budgeting to stay, ahead. Even at this $4,000 isn't enough to pay an employee. That's enough to pay a part-time employee because you still got overhead, and so on. So let's jump back here. I would assume 90% or more of you guys on this call, this is what your personal account looks like. You log into your personal account and you have a debit card linked to a checking account where you live off of, and 100% of all the money in your entire life is in this one account, right? Now, I discussed why this is wrong in the first one because you can't look at your bank account. I love it every day. I could wake up and I can look at my bank account and I can say, wow, this is how much I have to pay off debt, right? So, or to invest into real estate, which is something I would recommend to do. Now, here's the accounts. The first account you need to open up under your personal bank is going to be a debt/wealth account. So for $5,000 that comes in, you're going to put 5% and you're going to allocate that here, $250. Your wealth account, which is your company's profit account, in your personal life, I call it a wealth account because you want to learn to build wealth. How do I build wealth without owning a company? I'm going to show you how. You cannot build true wealth if you have debt. So your wealth account is really, it starts off as your debt account until all your debt is paid off. So this $250, you don't take nothing of that. You take it and you pay down debt. You take the next 250, you pay down debt. Next 250, you pay down debt. When all your debt is paid, all your bad debt is paid, this 250 goes in here, boom, it now stays in here, and you're going to start generating money that's going to build you wealth. Now, no, you don't get wealthy for having $250 in your bank account, but what you will do is over the span of 5 years, you will then have $10,000, $15,000, $20,000 in your wealth account to now give to maybe a real estate investor to invest into real estate for you. Maybe you invest into a real estate portfolio or into a rental property and someone in real estate manages it. So now you got money to where your money is making money for you and it's a bonus to this expense. So now you'll see you're living off of 95% of your income here because you allocated 5% to debt and wealth. Now, for the sake of this conversation, let's talk about the real revenue range. If you're earning $0 to $100,000 a year, that's what all these percentages are going to talk about. Now, the next account you're going to open up is a give account. Now, this is at 10%. We all know, if you're faith driven like me, we tithe 10% of our income. How many of us never give? Because we're living off of 130% of our income. I'm going to go back a slide real quick. Let's see. Here, most people are actually not living off of 100% of their income. They're actually living off of 130% of their income because they have so much debt, right? So just this alone, I already showed you how to live off of 90% of your income and allocate 5% back to that negative debt. Amazing, right? So what if you give? I believe in the law of there's a law of giving and receiving universally. If you're faith driven, God, whatever it is, universe, whatever your higher power you believe in, that if you give, the universe is indebted to you to give back, and it will give back to you in abundance, right? We hear that with tithing. You tithe and you will get back more in abundance because you're willing to give up what most of us can't afford. But if you give anyway, it's amazing. So now you're living off of 85% of your income. Here's what I do. Out of this $5,000, when I put $500 in my give account, I will tell you something personally that I do. I actually put 5% in here in my card for electronic money, and then I actually take $250 out in cash and I keep it with me on my person. The reason why I do that is because you never know when you're out, those times when you're at like a gas station and somebody walks over and they say, "Hey man, can I borrow a couple dollars?" And here's a great story of why this give account is amazing. And I had money in my center console that was my give account. And someone walked over and asked for a couple dollars. They said, "Hey, can I, you got $5 I could borrow or have so I could pump fuel?" And without a second decision, without any split second, I say, "Yes, sure." I go and I open up my door. I reach into my center console and I don't look for money. I don't look and say, here's a $1 bill, here's a $5 bill, here's a $20 bill, here's a $50 bill, here's a $100 bill. I don't look like that. That 100% of that money is my give. It's to be given anyway. So I reached into the center console and I gave him a bill. And immediately he looks at me and he gives it back. And I look at him and I'm like, no, that's yours, keep it. He goes, "For real?" And I looked at the bill and it was a $50 bill. He asked for $5, yet I gave him $50. And the reason being is because I got $500 to give, right? So if I'm going to give this $500 anyway, then I might as well, I make it easier for myself. I'm going to give. And if it's $50, he got lucky that I pulled a $50 bill out of that center console rather than a $5 bill, right? If I pulled out a 5, he would have been satisfied anyway, right? If I pulled out a $1 bill, he would have been satisfied anyway. But the fact that I give him a 50, I am now, blessing somebody else's day, and I'm with no expectation in return. I already know, though, because I'm willingly giving, I will get that, tenfold down the road in my life. So now when I say I leave the other 50% of this, the 5% onto a card, is because if I go out to dinner and I don't tip, with cash, I might tip on my card. So I might put a $100 tip on the card because because I'm giving away 500 anyway. If I got great service, I might as well make that person's day and tip them $100. So now I've given away $150 out of 500, and you start to enjoy giving more, and it becomes great to give. And not only that, the human body psychologically feels its best when it's giving. So, and you'll notice this when you give. That's why a lot of people want to give their time for free to people they love. So the next account you're going to open up is your education account, and you're going to allocate another $250 to this. Your education account is going to be a list of different things. It's going to be, maybe you buy books with this money. Maybe you hire a coach or a mentor with this money. And there's a coach or a mentor out there that you want to hire, whether it be a marriage coach, because we're talking about personal life, not necessarily business, but it could be anything. It could be business. It could be you hire a business coach, you hire an athletic coach, a parenting coach, a marriage coach. You read books, you go buy books, you take courses and programs. You're investing into yourself. That's what this education account is for, to invest back into yourself. Now you're living off of 80% of your income, right? With this, most people, again, are living at 130%. Now you're like, man, but where's the fun? Here's the fun, right? And you can see I slapped a debit card on the fun. Now it's getting exciting. So then you open up a fun account and you put another $250 in here. This is why the fun account is very, very, very important. When I open up my bank account and somebody says, let's say $250 is all I had in this account, and someone says, hey, we're going to do a golf morning and a steak dinner tonight. Do you want to go out with us? And I'm like, you know what? Let me look at my bank account. Or I'll say, yeah, give me 1 second and I'll give you an answer. And I open up my bank account and all I have is $250 in there. I'm going to rain check. I'm going to be like, hey, man, thanks for the invite. I love golf. I love steak dinners. Maybe not tonight. If you guys are open to this suggestion or this suggestion, that might be good for me right now. But if not, I'll catch you next time. You guys go have fun golfing. Enjoy your dinner. And, I'll catch up with you guys next time. Right? Because golfing is expensive. And a steak dinner is expensive, and that's going to be about a $500-$600 day. So I already know, because I only got $250 in my bank account, I can immediately say no and not feel any type of way, right? That there's power to that. Now let's go all the way back to the very, 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 very beginning. Okay, well, what's nice, we'll stick to this beginning rather than the very beginning. If somebody invited me out to golf and steak dinner and I had $5,000 in my account, and I just looked, and this is what my account looked like, and I just looked, and the only account I have is a checking account with $5K in it, I'd be like, heck yeah, let's go. I'll see you guys there. What time? And I would spend the money willingly because I don't know what I really have true to my life, right? So when I take away debt, and I give my money and I invest into myself and I have a little fun, now I can see how much money I have. You can see this is let's say 500. This is 500. So there's 1,000, 1,250 off of this already. So I'm already at $3,800. So I really only got $3,800 to live off of. Now, let's continue real quick and fill this in. So then we got big purchases and then member one. I'll talk about these two together. So Again, I give myself a debit card for the fun account because when I'm going out and having fun, this is my limit. My living expense is not my limit. My fun account is my limit. So then if I didn't pull this 5% down here, you can see it jumps, living expenses jumps from 75 to 65. It's supposed to be 70 because of this orange box, but I'll touch on that in a second. So then you have a big purchase account where you put 5% of your money in there. Now, this big purchase account is something for you, right? And the fun account is for you too, because you're like, man, I'm making all this money. It's very important, guys, in life to make money and spend it all. Spend every penny that you earn while you're alive. But imagine spending it on wealth, right? If you spent all this money in this wealth account, after $100,000 enter this wealth account, you invest $100,000 into a real estate deal that's going to make you money every single year. You just now upped your living expenses because of this wealth account, right? Imagine giving. Now you feel you have this dopamine reward that hits your life every single day because you're giving and you're giving and you're giving. So it's genuinely going to make you more happier the more you give. Then you're going to get another dopamine hit because you're investing into yourself, your education, and you're going to become smarter. You're going to learn more things, right? So you're spending, but you're spending it organized, not disorganized spending, right? And you have a purpose for your life, not a lack of purpose. Then you have fun. Now you get to enjoy some of the money you're actually earning. And you give yourself a budget and you blow through that budget, right? You could choose, let's say this fun account gets up to $2,000. You could choose to blow that $2,000 in one day if you wanted to. Or you could allow it to last you a month or 2 months if you want to. It's up to you to have fun with that money however you choose to. You guys see where I'm going when it comes to looking at your bank account and knowing what your life looks like? This is my personal account right now. And if I log in and I seen this in my account, I now know what my life looks like. I now know if I want to go have fun this weekend with the family, I can. I now know, man, there's a course that was $99. I got $250. Sweet. I could finally go buy that $99 course because I was wanting it. And so you get to see where you stand in your life. And a lot of people don't know where they stand. Now, this big purchase is the same. It's for when you want a house, when you want a car, when you want something, a vacation, right? You want to take a trip with the family. This is that big purchase account. That's what that goes to. Now, if I didn't add this double account right here, because you can see I dropped two at the same time. If I didn't add this would have said 70%. Most people, it is very, very hard to live off of 70% of your income. Why? Because most people live off of 130% of their income. So the start to greatness in your personal life starts when you are living off of 70% of your income. So get there, make it a goal, make it a mission to get there as soon as possible. And if you guys actually do this, you guys can start tomorrow. And guess what? If you can't do this, this is where a lot of people say, I can't do this. If you can't allocate $250 to a wealth account, $500 to give, $250 to educate yourself, $250 for fun, and $250 to a big purchase, because your bills are too much, your bank account is telling you you cannot afford your current lifestyle. Same thing with a business account, the operating expense account. If your operating expense account does not have enough money in it for that next subscription, you cannot add that next subscription. Your bank account is communicating with you. It's having a conversation with you, a relationship with you, and it's telling you how to live your life and how to maximize your life, right? So start by getting to 70%. Now, the reason why this dropped to 65%, same as the business account, every time you add a new account, you only take the percentage from the operating expense account because that's how you're operating your business. Same thing here. is when you add a new account, this could say member one, 5%, your wife, right? And your wife gets $500 for every $5,000 that comes in the door. Take that from your living expense, not from your debt, not from your give, not from your education, not from your fund, not from your big purchase. Any additional account that you add to your personal life to track and measure more parts of your life, take that percentage you put here that you're going to allocate from the living expense only. That's why this is dark orange and this is light orange, right? They combine with each other. Now you can open up another account that says member two, and maybe member two is you. So you got a husband and a wife account, and maybe you have a kid. So you open up another account and it's called member three, and it's your son or your daughter, and they get a certain amount of allowance every single, month. And so on and so forth. This could continue on forever and ever. Of how many accounts. It depends on what you want to track. So hopefully I gave you guys a large overview visual of how to simplify your life moving forward. The goal with this is to really live off of 20% of your income. Real wealth, you will know when you're truly wealthy when you can survive and live a lifestyle, an amazing lifestyle, off of 20% of your income. So let's talk about it. There's the 70%. Ready? A. Here we go again. Real revenue ranges, if you're making $0 to $100,000 a year, you're in the A range. And the A range says you better be living off of 70% of your income. And if you're living off of anything more than 70%, you need to change something about your life. Maybe you need to sell the car you're currently leasing, and you need to get a new car that has a lower payment, right? If you're in a house and your rent is $3,500, $4,000 a month, maybe you need to downsize and get into a house that's $1,500 a month. If you have credit cards and you're using all these credit cards or all these subscriptions, maybe you need to cancel some subscriptions. Maybe you need to cancel some credit cards. There's something going on in your life that's causing you to be over 70%. We need to figure it out, and we need to start getting rid of a lot of those things. Here are the allocation amounts. 5, 10, 5, 5, 5, right? Now this one's just there from the last one. It's just going to stay there probably. Yep, you can see I delete it here. So if you're earning $100,000 to $250,000, here's what changes. You should be living off of 65% of your income. If you're making that much, you now have choice over this. Immediate choice. A lot of people, it's going to take them a long time to get to 70% of their lifestyle. For you, if you're earning $100,000 to $250,000 a year, which is most of you on this call, because either I've coached you through it or I know a relationship through this, a lot of you guys might be in these A and B sectors, right? Earning 0 all the way to 250K. So if you're making $100,000 and you're in this B category, let's pay attention to the percentages moving forward, and I'll tell you what changes. So you go from 70 to 65%, and you up your education from 5% to 10%. Why? Your percentages are changing based on what's immediately the next most important investment in your life. So giving is always important. If you'll notice, your give account stays at 10%, just like your tax account stays at 15% in your business. Those never change because you should always tithe, do your giving, and you should always prepare your taxes and have those taxes ready, right? Those are always a must and a non-negotiable. So you'll see this never change. However, if you start to earn more money, it's very important to start investing into your education a little bit more. You can see out of the $5,000, you're living off of $3,250. Out of $5,000, you should be living off every $5,000 that comes in. You'll be, let's say it's $5K a month. $5,000 a month is good because that's about $60,000 a year. You'll be living off of $3,500. This is your house payment, your phone bills, the food, the car bill. If you have a car bill, everything must equal $3,500 or less. And if it doesn't, you need to start adjusting your lifestyle. Now for every $5,000 that comes in, you're living off of $3,250. From this point, you're probably earning about $10,000 a month because now you're at 100 to 250K. Now the next immediate one, you'll see your debt and wealth account increase to 10%. Because if you're earning 250 grand to $500,000, for every 5,000 that comes in, you apply $3,000 to your living expenses, and now you start to build your wealth even more. Either you're paying down debt a lot faster, while you're getting a lot smarter, you're giving abundantly, and you're going to start paying down your debt faster and getting into wealth a lot faster, right? So you see how that goes. The next one is actually going to be your big purchase that drops you down to 55% of your living expenses. Your big purchase, now you get to expedite your speed to a newer car, to a newer house, to a family vacation, right? That trip you've been saving up for. Then eventually, that's from 500K to 750K. You're in the D range. And now when you get into the E range of 750,000 to a million, you'll be living off of 50% of your income. So if a million comes in, you're earning $500,000 a year as a person. As $500,000 comes in, this is what you're doing. You're allocating it 10% all the way down. Then your fun. Now you got to increase your fun, right? If you're making a million, go have $100,000 worth of fun. If you're making $750,000, go have $75,000 worth of fun. Also have $75,000 worth of education. This is where you start paying for elite level coaching, like your top dogs that are, you're paying them every year to get you to the next range in life. You're giving a lot more abundantly. Now you're out of the debt account. Hopefully, you should be way beyond out of debt, and you should have multiple real estate properties by now with this wealth account. Then there's another range. There's the range that is anything over a million. Technically, anything over a million. There's more, but this is personal. If you're making $1 million to $2.5 million, there's again some more advanced trainings that I'll talk about later to where you really don't earn this money, where you can operate as a business. But we'll talk about that in an advanced training. Now, if you're over $1 million, you should be living off of 40% of your income. So $1 million comes in, your lifestyle should be under $400,000, right? Meaning your house, you shouldn't have a house with a mortgage over $5,000. You shouldn't have car payments, bills, any expenses, nothing that adds up to equal over $400,000 a year. But now look at what happened. Now you jump from 10% and you skipped 15 and you went straight to 20 in your wealth account. And you're still living off of 40% of your income. Hopefully you guys are seeing where this is going. Now the goal is to get this down to 20% of your income. Based on how you actually live your lifestyle, you could get this down to 20% here. You very, very fast. Because if you're earning $250,000 a year, 20% of that is $50,000. You can easily have a $50,000 lifestyle. That's a $2,500 a month rent. That's really good. You can find a new build house, luxury new build house for that. You can have 2 car payments, and take care of all the food in the house and all the Wi-Fi and all the tiny little expenses with $50,000. So you can choose, again, this is to create a habitual behavior to start allocating your money lower and lower and lower as you scale. But the faster you choose and decide to make your lifestyle 20% of the earnings you make and maintain that the rest of your life, you'll have more freedom. So that is today's training. I'm going to go ahead and bring it all the way back to the very beginning and have a discussion with you guys. Hope you guys got some information from that you can apply to your life today. Again, within 24 to 48 hours. Don't let this go, past 7 days without you getting to the bank, opening this up. In the next immediate check that hits the bank account, you start allocating your funds. Now, if you have questions, I encourage you to ask them in the Facebook group. I encourage you to ask them where you can and reach out to us so that way we could get them answered. There is more in-depth stuff. There is more advanced information on the ideal banking system. However, until I get to that advanced video, this should get you guys started for success moving forward.